Randy Krause, as the top Fed bank regulator during the Trump years, would you have done the same thing that they did, the FDIC, the Treasury, and the Fed?
Well, I would have. I think I would have pressed harder, as you were discussing in the earlier session. I think I would have pressed harder for a private sector solution. This is a pretty attractive franchise, this bank. Its fundamental business, its customers would be attractive. I think that if the FDIC were really working at it, it would have been possible to find a buyer over the weekend. If they have been reducing the universe of buyers, artificially excluding some people, if the terms have not been appealing. Because the way this works, as you know, Larry, a buyer comes in and negotiates with the FDIC over how much of the potential losses in the institution the FDIC will cover in order to induce that buyer to quickly buy the firm, because you don't have weeks and weeks to do due diligence on the institution. And if the FDIC isn't being forthcoming on that, then you're not going to have a private sector solution. And I would have preferred, this solution will work, and I support it given that there wasn't a buyer. But I think if the FDIC had been working harder, there would have been a buyer over the weekend.
Randy Krause, let me play you some tape from something President Biden said today about regulation. Hang on a second, please.
We put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law, to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements.
Unfortunately, the last administration rolled back some of these requirements. What do you think about that? Do you agree with them or not?
Well, I think that that's wrong. Obviously, we did refine a number of the banking requirements. None of those were at issue in what happened with either Silicon Valley Bank or Signature Bank. None of the capital changes that we made had anything to do with what happened at SVB. None of the liquidity changes that we made had anything to do with what happened at SVB. I think that there are interesting questions to ask about how you can improve regulation and supervision going forward, dealing with the performance of uninsured deposits in this new world where Twitter amplifies and accelerates herd behavior. So the liquidity rules that have always applied, the Trump administration didn't change anything about this to uninsured deposits, treat them pretty leniently, pretty close for liquidity purposes, for the stability of a bank's funding, to insured deposits. They generally don't run all that fast. They haven't over history. So now in this new world of Twitter and social media, maybe they should have a bigger haircut. That's nothing that we change. That's always been the case in the liquidity regulations that were put in place after Dodd-Frank. It's worth thinking about, and certainly worth thinking about how you look at uninsured deposits as a supervisory matter, even apart from a regulatory matter. But the idea that anything that was changed had anything to do with what happened at SVB is just wrong.
Right, because this is fundamentally a liquidity issue, liquidity mismatch. This is the upside-down curve. But I thought, Randy, that some of the deregulation was to take reporting requirement burdens off of the smaller banks and the community banks, but you left the stress tests and whatnot on the large banks. Now, I don't know, maybe they didn't stress test this bank. Can you comment on that? What do you think has happened here? I mean, it is a mystery that they so badly managed their risk management on the security bond portfolio. I mean, the mismatch between assets and liabilities. That's something of a mystery. You would think professionals would do better, but I don't know. What do you think?
Well, I agree that is a mystery, because it's been fairly clear what the mismatch was, and it's been fairly clear what the Fed's path for monetary policy was going to be for a long time. The Fed has been as transparent and as articulate about what the path for monetary policy is going to be as any Fed in history. So they should have seen this coming, and if they'd reacted soon enough, you would have been able to adjust the bank's portfolio of investments so that this wouldn't have been as big of a hit. Can't tell you why it is that they didn't, but I can say that it's not really a function of anything regulatory. It is, as you said, it's an old-fashioned bank run, and There's no way you could. There's all the capital in the world is not going to protect a bank that has $40 billion withdrawn from it in the course of a few hours.
All right. Randall Quarles, we appreciate it. Formerly the Fed's top regulatory and supervisory person. We appreciate your time very, very much. All right, folks, coming up here on Kudlow, Mike Powell, Kevin Hassett. He's going to weigh in on this whole story. Was this a non-bailout bailout? What's the root cause of this? How about that? Maybe it does go back 2 years, as I suspect it did, because we've had an upside-down economic policy. Free market capitalism is the best path to prosperity. We need more of it. I'm Kudlow. We'll be right back. Joining me now, Kevin Hassett, former chair of the Council of Economic Advisors. Welcome, Kevin. Your first instincts on this Fed, Treasury, FDIC, I'll call it an assistance plan. What do you think of it? Is it going to succeed? Should they have gone? You know, Randy Quarles said he would have been happier if the private sector, somebody bought the thing right out. What are you thinking here?
Yeah, I think Randy's right, and you're right. And, you know, I have heard it from, people I have a great deal of faith in that were very close to the situation, that there were buyers who are willing to step in and buy the bank, and that the radicals at the FDIC basically weren't going to allow that to happen. I even heard, again, someone told me this directly that was close to the situation, that the Biden administration had a whitelist of companies that were allowed to buy the failed bank and companies that weren't. And so basically you could imagine they're so concerned about some bank getting a little bit bigger that they've decided to put all these taxpayer monies at risk. And I think it's something we've seen from the Biden administration really from the beginning, is that they've got this radical left agenda, and it doesn't ever exude any even common sense. And so here we are in the middle of a potential banking crisis. We've got people willing to step up and buy the company, and the radical left-wingers at the FDIC won't let them do it. And so I think that that's going to go down. You know, it's something that we should have hearings about, and we should find out exactly what was going on. But I've heard it from people very close to the situation who I trust. And you saw Senator Haggerty was tweeting about it too. And so it's a scandal, frankly. And the problem with bailouts, right, is that suppose that you're a bank right now and you're not really doing so good. You took some bad bets. The bets are down. Well, if your guys are going to be bailed out, if your depositors are going to be bailed out no matter what you do, then you should swing for the fences, right? You should take the biggest risks that you can to try to, double down and get yourself out of trouble. And so what usually happens when regulators come in and try to, outsmart the market and provide backstops is that risk goes up, and eventually something really horrible happens. And I hope that it's not this time, or it's way off in the future, but I think that's the risk of where we are, is that there's a moral hazard risk that people are going to, take bigger risks to dig themselves out, and then when they lose that money, there's going to be even more and more bailouts that have to be done.
I'm very concerned. I mean, I totally agree with you, what you're saying. And I mean, I think the Bidens would rather have the government run these banks. And if another bank has to go down and the FDIC, in other words, I don't think they have any problem with government-run banks. I think their policy would skew in that direction to begin with. That's a socialist view. That's a big government planning view. It goes along with all their excessive regulations. I don't think there's a problem. They don't have any problem with the FDIC running these banks.
Yeah, that's right. And if the government is guaranteeing the depositors, and then they're going to have to regulate the risk taking, because otherwise there'll be the moral hazard problem. And basically you have a national bank. But the thing that I think is really the most obvious clue to the shamelessness of the Biden administration in this crisis is that they came out and they blamed the Dodd-Frank rollback, which was a bipartisan bill in 2018. You remember it well. I think there were 17 Democrats that supported it. But Barney Frank was on the board of Signature Bank. And Barney Frank came out today and said there's no way that 2018 law had anything to do with this. So Barney Frank himself is saying that the Biden administration's yes, he did. They're full of garbage.
That's what Randy Quarles
so to be out there finger pointing.
That's what Randy Quarles just said.
Yeah, Randy was right. And Barney, Barney Frank is a smart fellow, and he's a good guy. He speaks his mind, and he said no, Biden's wrong about that. But the fact that they're finger pointing, in a crisis and trying to make political gains is a sign that it's just like a total political calculation for them. And again, that goes back to why they wouldn't let the FDIC sell the bank, which is the obvious way to let the private sector fix the problem.
Absolutely. Kevin, last one. Our mutual friend Larry Lindsay, a great economist, he argues today that the bailout, or the assistance plan, I'll call it, leads to both higher inflation and contraction in the economy. Do you want to put some words on that piece of toast?
Yeah, Larry saw this coming before everybody else, and his piece today was something that, I think made a great deal of sense. But the thing that you have to understand is that what they're doing now with the bailout is they're printing money to solve the problem. Mm-hmm. And there's this inflation problem that really started the whole thing. And they're trying to fix a banking problem now by printing money, but that's just going to make the inflation problem worse, and it's going to create more problems with more banks down the road. And so I think that we're in a difficult spot. I'm very interested to see if markets are going to digest this and not panic. But me, I'm pretty close to the panic button, because it feels like policy is exactly wrong.
But no loans and a tightening of loan standards, and this bank was essential to Silicon Valley and the tech world, that's contractionary. That's going to drive the economy down even while inflation goes up. That was my read of what Larry Lindsay was saying.
Yeah, that's right. And then if they don't let somebody come in and buy the franchise mm-hmm. and start lending to those folks again, then it'll have a real effect on innovation in our country.
Yeah, that's just we got to get out, Kevin. But you mentioned innovation. I've seen a few articles from Democrats who say we got to take care of these banks, bail them out, blah, blah. And this is no time for moral hazard concerns, blah, 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 because we don't want to lose innovation. This is the same gang, innovation. Joe Biden's budget has roughly $5 trillion of tax hikes, and you've got wealth taxes and capital gains taxes and corporate taxes that would destroy innovation. I mean, his tax policy would you can have as many FDIC bailouts as you want, but those tax hikes will destroy innovation, absolutely destroy it.
Right. Right, and the road to socialism is paved with bailouts, right? and one of the reasons why they want to do the bailouts instead of letting the private sector solve it is then they get to give money to people they like and not give money to people they don't like. What do you think would happen if tomorrow a bank fails where Donald Trump has billions of dollars sitting?
Oh, no.
You think they're going to make the depositors whole?
Of course they will.
Sorry.
Of course they will. Kevin, did we put Kevin's book up? It's the most important book of the 21st century. There it is, The Drift. And he's talking about the drift towards socialism. And we just saw a wee bit of a drift over the weekend. Kevin Hassett, fabulous stuff. Thanks ever so much.